Hi, I'm John Papola, and you're listening to the Emergent Order podcast. This episode of the Emergent Order podcast is a little bit different. I was approached by an economist named James McClure, who's a Facebook friend of mine, asking me if I had an interest in hearing about a theory that he and David Thomas at Ball State University had about the causes of booms and busts. And having started my life and career transformation creating Fear the Boom and Bust with Russ Roberts, I couldn't help but take him up on the offer. And after hearing his theory, I thought, man, as much as I love this stuff, I'm sure it would be even more interesting to bring together some of my favorite macroeconomics professors and monetary theorists. I invited George Selgin, Scott Sumner, Steve Horwitz, and several other folks as well to hear James and David out and sort of interrogate them on the pros and cons and the strengths and weaknesses of this new theory. It wasn't intended to be a podcast episode, but after we got done, I thought, man, this is worth sharing for people who are as geeky as I am about economics. And for those of you listening in audio, you can see the video on our YouTube channel at youtube.com/emergentorder. So I hope you enjoy this Macroeconomics Roundtable. So James reached out to me over Facebook, wanting to geek out about economics and prospective video ideas, because who are you going to geek out with about economics and video ideas but me? And then we had a long conversation that I have no credential to participate in fundamentally about his him and his partner's theory on David's theories about capital and early stage investment. And I immediately thought after hearing it, well, this all sounds really interesting. And I would love to just sit in the aisle while some Austrian economists I really respect beat it up.
See, this is why you need to come to Ball State. This is what we do all day long in the hallway, right?
we do.
So with that, I thought, okay, Steve's at Ball State, so that's great. And as far as wisecrackers that could beat up a macro theory, I can't think of somebody more suited to the test than George Selgin. So you got a good audience here to take some whacks at your models. And with that, I'll turn it over to David and James, and this is an emergent order from here on out. So I'm here to listen and
explain to everybody that I'm going to attack it whether it's good or not. So you should.
All right, George. I'm looking forward to it. Let me just make a few remarks in thanks to John and especially Steve here for all the advice. Steve has advised us and guided us, and we were really lucky that Steve came to Ball State. I had been assigned to teach macro about 10 years ago, way before Steve got here, and I hated aggregate demand, aggregate supply, and I went off and I started reading Garrison's book, and I sort of it's like Hicks says, everybody who sees Bombal-Works theory and this capital structure theory, I think Hicks said, falls victim to it. And I did, and I was very intrigued by it. And because as a microeconomist myself, I'm very interested in the idea of relative prices being thrown off in a macro story rather than just some general price level P, and the Austrians do that, of course. And so David came to Ball State about 4 years ago, and we started kicking these. He had been trained at George Mason, where the capital structure theory is taught, and as a result, we had some discussions. And David's background is as an entrepreneur, as a Silicon Valley entrepreneur, and we started talking about this structure of capital triangle one day in his office, and he did something very strange. he put another triangle that was separate from the original triangle, and he kept tracing around it. And it reminded me of the movie where the guy is seeing UFOs and he's playing with the mashed potatoes. And
Close Encounters of the Third Kind, one of the best movies ever.
And people are looking at this guy, and I'm looking at David, and he's going around and he's playing with his mashed potatoes, and I'm thinking, what is this guy doing? But eventually we, through talking with Steve, I remember the one day it happened when I finally understood what David was trying to get at, is I went down to Steve's office, I started talking to him about this, and he said, well, he loaned me Hayek's Prices and Production book, and he says, well, you got to look at this. And Steve's all the time telling us look at this. So I took it, and David and I looked at it, and we realized that Hayek was talking about stages of production. He wasn't talking about research and development. And the thing that really throws a lot of people, I think the thing that hid this from a lot of people, that research and development is different. And David knew this because he had been hiding research and development from his competitors. He had been signing his employees to employment agreements where they had to remain quiet pre-launch. And there was a big build-up to the launch, and he knew about this. But anyway, we just kind of stumbled into all this, and we got this first paper about sticky consumption published in the Review of Austrian Economics. And that's something that's not in the Austrian model either. The Garrison model has the bust being represented by a crash in consumption. And that's something that Hayek would very much have disagreed with. But David and I went around and looked at the evidence, and we found Angus Deaton's work where Angus talks about how consumption is very smooth. It's not like that at all. So here was a piece of the Garrison theory that I admire so much that was off relative to Angus Deaton's work. And so we worked on this. Finally, we got a paper together about sticky consumption, and that was very interesting with the Sequester Capital piece in it. And then after that, we went looking for an empirical example of this, and we found Tulip Mania. And we got that published in the Financial History Review. And so it all kind of fell into place. And after we found the Tulip Mania example and got that published, we thought, well, if we're right, if this is something that has general implications, we should find evidence of this sort of thing in the 1929 crash. And so we went looking for it there. We went into the literature, started reading it. And again, we're talking to Steve a lot about this because Steve studied the Great Depression a lot. And we stumbled onto this paper by DeLong and Schleifer, where they talked about these closed fund these investment trusts. But then we noticed that even though they talked about the existence of blind trust, they never did any statistical analysis to sort out and analyze them separately and see if there was any difference. And so, three of us got together and kept working on this, and we found evidence that in fact it does matter. And you would expect it would.
Right, that the trust that did not disclose their portfolios were unsurprisingly mispriced, and then when disclosure happened, those prices corrected in ways that align with the funds who had been disclosing all along.
Mm-hmm. And so this is very much in line with the Tulip Mania finding.
Right, and the sequester. So the idea being that there was a sequestering of capital that was happening there that made it impossible or difficult anyway for the price system to operate to accurately price those.
And David's got a few slides that he would like to share and kind of walk through the ideas, some of the key points. He's got about 7 slides, I think, And hopefully that's okay if David could show and talk about those slides.
Could I get make a comment? I'm the only one here just about. I don't know how much John has been filled in on this, but I'm the only one here who hasn't been part of this research discussion. And so far, I've heard about a lot of stuff you've done, but I haven't heard any thesis or particular thing. You've said this is important a lot of times.
Well, that's
but
what
I don't even know what this is.
Well, that's what David's going to show you.
Okay, well, yeah, because I mean, otherwise, it's just going like this, right?
No, we're not like that, George.
Well, no, but my time is a little limited, and so
okay. Well,
the more we get to the meat of this, the more I can really feel like I've got something.
George, if you wait 7 slides, you're going to get a special treat.
Okay.
Okay, so let me just bring up the slides. I'm going to be using this new feature that Steve taught me about. It lets me stand up and I can be down one. So just a quick quote from Hayek's early vision here. This quote, "There is no necessary reason why the initiating change, the original disturbance eliciting a cyclical fluctuation in a stationary economy, should be of monetary origin, nor in practice is this even generally the case." But then it goes on to say, "This phenomenon, a cycle that contains the seeds of its own reaction, as we have seen, should undoubtedly be ascribed to monetary factors, in particular to additional credit, that also necessarily determine the extent of the cycle." So the 3 key points he was making here was there was an original disturbance, generally non-monetary, but that monetary factors fueled the business cycle, and that additional credit determined the extent of the cycle. So,
So additional credit means there has to be an actual increase in the nominal supply of credit?
an additional increase in the nominal supply of credit.
Is that what that means?
We believe that's what it means.
Yes, yes. And it could come about through the banks, or it could come about through other financial innovations. For example, derivatives during the housing boom.
Could you go back to your first slide?
Sure.
Yes.
I'm not sure I understand the import of what he's saying. For example, if he's saying that the origin can be non-monetary, well, let's suppose there's something that raises the natural rate of interest, or would that be an example of a non-monetary impulse?
Well, that's what he gave as an example.
Yeah.
Yes. Yes.
Because wouldn't there be some cases, though, for example, suppose the demand for real money declines, right? The demand for savings to hold real money balances would raise the nominal, the real natural interest rate, right? So everybody's deciding, they're reducing their demand for real balances.
He gave that very kind of example. Yes.
In that case, wouldn't you have the beginnings of a cycle if the central bank did not expand the nominal quantity of money, because you'd have an excess supply with the given amount of nominal money?
Yes.
That would then contradict, though, what you just said, that there has to be an increase in nominal money supply to start the cycle.
No, we don't say. Go ahead, David.
I think what we're saying is that, and I'll get to this, is that the monetary factors, as we have seen them, are in response to the disturbance. And so, in other words, there was a tremendous demand by consumers in 1929 to invest in the stock market. They really wanted to invest in the stock market, but there wasn't a mechanism for them to do that. The market responded by creating these blind trusts. They were the first mutual funds. Yeah. So in this case, the financial innovation that occurred was in response to the demand for investment on the part of consumers.
But
in the case of,
I'm trying to understand analytically, though. I'm sure there are other examples that don't fit what I'm saying. But is it not the case that you can have reduction in the real demand for money balances is the non-monetary origin of a cycle, which then doesn't require any expansion or additional credit that determines the extent of the cycle. That is, you're going to have a cycle with zero additional credit. And if so, what's Hayek trying to say in this?
We don't believe that that's a typical cycle.
That's what this paragraph, it fits.
No, what Hayek is saying here is that in the cycle that he thinks is generally, I think that he thinks is generally playing out, is that the original disturbance is generally non-monetary. He says that. Okay. Yeah. And we think so too. Okay. And we're going to get to what we think it is in general.
One way to think about this is whether there are errors of commission or omission on the part of the central bank, right? I mean, that's another way to think about it too, right? That it doesn't necessarily require, as George said, an increase in the nominal supply of money. It can be an inaction by the central bank that also allows monetary disequilibrium to become a cycle.
Is this? I'm curious, George. Is the distinction you're trying to draw the difference between talking about absolute changes in credit supply versus relative changes in credit supply versus demand, like sort of compared to nominal GDP? I'm trying to understand. I assume that when you guys put this quote up that you agree with it. Maybe I'm wrong.
We do.
But if you do, then it says very emphatically a cycle that contains the seeds of its own reaction, which I take it is what we mean by any cycle in these discussions, should undoubtedly be ascribed to monetary factors and in particular to additional credit, which I assume means additional nominal credit, an actual expansion of the nominal stock of credit by the banking system with the central bank involved. If that's true, then the most obvious case I can think of where the initiating change does not have to be a change in the nominal quantity of credit would be a reduction in the real demand for money balances. But in that case, you would have a cycle that doesn't require the nominal expansion of money. And so I can't make sense out of this paragraph.
It seems like it's a focus on M instead of MV.
Yes. Right? I mean, one way to put George's point is V goes up, right?
Yeah.
In this case, it's V going up, which is non-monetary in the sense of it's not a money supply. I don't know what else you could mean. This is a monetary theory of the business cycle, right? So we assume it's either M or V. There ain't anything else. If so, what's a cycle that has no non-monetary?
I'm gonna play referee, George, for the sake of let's keep going. We'll put a pin in on the absolute credit and sort of the allusions to sort of like Friedman-esque money supply nonsense, and like let's see where this goes.
All right.
So one of the things that we wanted to stress was that Hayek was well aware that consumption was sticky. And we have a quote here, for example. He says, the demand for consumers' goods, talking about the recession at the time, was very well maintained for a long while after the crisis occurred. And we, of course, went in and, of course, looked at the evidence. Here's, for example, a look at disposable income per capita, real disposable income per capita, real accrued consumption, overlaid. And as you can see, the demand of the disposable income is highly volatile, while consumption is very steady. And of course, this is intuitive, right? If you get laid off, your income goes to zero, but your consumption does not go to zero. I mean, so people's consumption is very sticky and very steady. And
this is like the permanent income hypothesis, isn't it?
It's very similar to that, right? But it's not quite the same thing, right? The permanent income hypothesis is about how people will act as though their income is going to be at a certain level their whole lives, and then they'll respond to that by borrowing early on in their lives and so forth. This is about just people's general pattern of consumption, and that people are going to, they have a certain amount of rent to pay every month. They have a certain amount of car payment to make. And so their consumption is very steady. Now, in the process of looking at this, you'll notice it says accrued consumption. What we discovered was the government reports consumption on a cash basis. So if you buy a car, you drive it off the lot, that car is consumed. The government reports it as consumption that instant. But we all know that, in fact, that car will be consumed over about 18 years by various people, because that's the average life cycle of a car. And so in business, if any business used a cash basis for their accounting of that magnitude, they would be put in prison. But the government does what it does. And so what I did was, because of my accounting background, I went in and was able to find the numbers from the government to recalculate consumption on an accrual basis.
For all durable goods? For all durable goods?
For all durable goods, yes. And there happens to be a division of the government that maintains this number. I didn't even know about it, and it's not really used by anybody, but they keep track of all durable goods purchased by consumers, and they depreciate them over the appropriate time. And so by replacing the consumption of durable goods with the depreciation of durable goods, we get a even more sticky consumption, because those things play out over longer periods of time.
Yeah, even more sticky or smooth than Angus Deaton would have estimated.
Okay, now I just want to say this. We have a special treat for you. At the end of this presentation, we're going to unveil the first leading indicator of recessions that was discovered during the application of our theory. And the indicator has predicted every business cycle since 1929 with a 6 to 9 month lead cycle.
I told you there was a special treat, George.
Okay.
Here it comes.
But you wanted the theory.
Skepticism spring is being compressed now very rapidly, so I can't wait to see it unleashed.
So this is our basic view of what we call sequestered capital business cycle. So you have an endogenous element going on here, and that's a period of rising prosperity, economic growth. Now we apply sticky consumption to that. Incomes are rising, consumption is sticky. The result is savings grows. As savings goes up, more and more people save, interest rates go down. The savers, now seeking for a higher return on their investment, looking for someplace to put it, discover certain sequestered capital. Now we'll talk about some examples of sequestered capital, but sequestered capital offers higher returns, but lower transparency. And so often people will believe the risk is low because they don't understand, they don't have the transparency to see what's there. And so they'll think they're investing in something rock solid, but in fact they're not. So we refer to that as sequestered capital because some key piece of information is being withheld. This generates a positive feedback loop. And the positive feedback loop then starts kicking in, and the prices start going up. That then sends a message to consumers, oh, look, I was right. More people start investing. It rises, rises, rises. But at that point in time, you need a financial innovation to fund this. And so what we've discovered is that in every case, some kind of financial innovation emerges that provides a credit expansion. And it's endogenously in response to the demand from consumers who want more money to be able to invest in this thing they're investing in. And I'll give you some examples in a minute. Then the information emerges about the sequestered capital that was being withheld. That results in the bust and correction. And then, of course, you back into your period of prosperity. This is your cycle as we define it here. So those are the elements of our business cycle theory.
So I'm not sure I understand the initiating mechanism. Usually we distinguish between the steady state as the economy is evolving without any shocks or disturbances, right? And what happens when there's some kind of new innovation to something. But you seem to be suggesting a kind of a secular story where, because consumption is sticky, we can be going along a growth path but savings are going to pile up.
Yes.
They are going to pile up.
Start it. But in the steady state, your consumption at any time is a function of savings of the income you received in the past. And so you should be able to define a steady state where there's no implication that savings and that consumption is not going to itself be in a steady state. That is, it can be a growing steady state, but there doesn't have to be, this can all be a sustainable path.
You're absolutely right. It could be. It could be sustainable.
There has
however,
to be some surprise or something, right? To knock it off the sustainable path.
So we're going to show you some empirical evidence of this occurring on a regular basis, looking at the data.
I hate to start with evidence. I'd like to know what the story, the analytical story.
No, I'm going to. Let me finish. So we're going to show that to you. But the basic idea here is that you have this divergence because of economic growth, where the consumers have a certain lifestyle, certain expenditures they're making in their life, and their income is growing. And as their income is growing during this period of time, it's piling up. And it's piling up in the form of savings. And as that does pile up, then it reaches a point where they're looking to try to get a better return because of lower interest rates. Now, one of the things that we look at is this notion of accrued consumption. It's very important because part of our savings story is the investment in durable goods. We always think of buying durable goods as consumption, but in fact, they're a form of savings. It's a deferred expenditure. You're deferring expenditures into the future by buying a car. You're paying for it right now, but you're consuming it over a long period of time. So in a sense, it's a form of savings. And as people expend their money on all these durable goods, a house, a car, furniture, these things, they're putting money into these forms of savings. But at some point in time, they say, look, I have my car, I have my house, I'm happy with what I have. Now I've got all this income that I have been spending on these things, and I want to put it somewhere else. So now I'm going to put it into I'm going to invest it. And this is what the evidence shows, is that you see this investment in durable goods rising, 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 and then it turns and heads south, and investment starts heading up after that.
But, that makes sense for an individual, but you're dealing with the aggregates. All these different people are making these different decisions at different times. There's no reason why there should be a little cliff there where it then adjusts for everybody, right? One guy bought a Buick, last year. I buy mine next year. Another person bought. And when you put all these things together, it's no reason why it would add up to that story for the aggregate, or is there?
There is, because of the cycle. So what happens is people, in a sense, when the cycle ends and the recession ends, now people are coordinated into their efforts to start buying again. They all come together at the same time, and they go through this purchase cycle.
But you're assuming a cycle to explain why a cycle happens.
Right. That's question begging, right? I mean, one of the things I've been pushing back at these guys about is a version of this, which is that you can't get a cycle in the sense that we think of as a cycle without some monetary, without something, well, what Rothbard would have called the cluster of errors. You can't get it without something that's widespread enough to explain why, to go back to George's previous point, everybody's making the same mistake at the same time.
We're doing the same thing at the same time.
You're right, doing the same thing.
And that is what's explained by the sequestered capital. So what happens is there's some kind of innovation that's a sequestered capital that becomes available on the market. And the consumers who have the savings, they pour their savings into it. So in other words, they built up the savings. We don't know when that sequestered capital is going to come. We don't know when tulip mania is going to hit. We don't know when the real estate.
We don't know when there are going to be 500 automobile companies in the United States. We don't know that. We don't know when automobiles are going to replace horse and wagon.
Or electric utilities.
But things like this happen. All right.
They happen regularly.
All right. And these things, George, are sequestered capital. Why else did we have 500 automobile companies?
Because people wanted automobiles.
Well, it was duplicative. It was duplicate research and development, and not very many of them survived, George. Why was that?
Hold on, fellas. Now you're talking about some innovation. Now you've got a story where something happens.
Yes.
Yeah.
Right?
Yeah.
Okay. But you didn't say what. That's why I'm
Okay, you're right.
So is there some kind of technical or some other innovation that gets people excited?
Yes.
New kinds of durable goods.
Yes.
And that's in number 4 here. There's a shock to demand for some kind of sequestered capital. There it is. Okay.
That'll give you
this thing hits. Yeah. This hits. Whatever it is, it hits. And it's a shock of some kind. Okay.
All right.
So I'll tell you what. Let me keep moving.
I have one question about the part 1, 2, and 3.
Yes.
And it's a little more of like an observational question. So in the aftermath of the financial crisis, a thesis I heard kicked around was the notion of a savings glut, which sounds like what you're describing. Like you have China having been allowed to start to have something that looks like private property, has all this ability to start getting rich by importing technologies and starting businesses and unleashing the latent entrepreneurial energies of the Chinese people. And so you have this rising income, and they're a high savings rate country to begin with culturally. And so you have this ever expanding glut of savings that pushes rates down. That sounds like what you're describing.
Yes, that's what we're describing.
Right, but John, I think the cause here is it's the mechanism from 1 to 2 is that as incomes grow, again, steady state growth in income, consumption lags it for the reasons David talked about before.
Right.
So there's
in the steady state, nothing can lag anything all the time in the steady state.
Yes, but that's where that excess savings is coming from, as opposed to the story that was told about, right? Even the word excess is problematic there. More savings.
This is what I didn't understand about the savings glut story. This is the thing when I was talking to James about it that I was curious about, which was, it sounds like what you're suggesting is a high growth economy will be more prone to cycles.
That's correct.
Than a low growth economy.
Yes.
And I guess because the low interest rates will cause a chase for yield, and that will drive people into this more volatile investment sector.
That's 3 and 4.
Yes.
But John, where you and I got into disagreement was that you wanted to compare across countries, and I didn't want to do that because the ceteris paribus is so the conditions are so different that those cross-country comparisons can be very tricky.
Well, this was my question: is like, has China seems like a perfect test case for. So, what's their business cycle look like? Or what does India's business cycle post-1990 look like relative to everybody else?
But before we go there, I want to pull it back for a second, all right? Because when these guys started talking to me about this, right, my instinct with these things is to say, why isn't the market for loanable funds equilibrium, right? That's my first question.
Rates go down. That's good. That's fine.
Right. So, for example, why is 1, 2 is not a problem in and of itself? Right, if there's increased savings and rates are falling, and
pro growth,
that's a natural market rate match, and it's fine, right? Savers seek higher rates of return. Okay, but where's that coming from is the question, right? Who's going to offer them those higher rates of return unless there's real resources there to do it, right? And I think that's the question in 3, 4, and 5 here that I'm still not persuaded by.
You know, the world has seen savings as we get richer, savings go up in proportion to consumption in a permanent way. That's been happening forever, since the Industrial Revolution. It's never posed a problem. It doesn't cause, it doesn't lead necessarily to declining interest rates, real interest rates, which would be true if the secular stagnation hypothesis were true. Now that's gotten a fillip in recent times, but generally speaking, we've had productivity gains so that interest rates don't decline. And the point is that an increase in savings as a percentage of income itself doesn't guarantee that real interest rates are going to decline, that you're going to have secular stagnation or any of those things. And this is ground that's been covered quite extensively in the literature.
Yeah, George, it doesn't cause the problems that you and other people have been looking at, but it does cause the problem that we're looking at. It causes a problem with money going into sequestered capital and causing a boom and a bust. And you're going to see evidence of it here shortly.
All right, go. Move to the,
Okay. So I just wanted to show you this really cool graphic of this brochure that I dug up from the archives of the Federal Reserve. This was a brochure that came out in 1940 showing all the business cycles since 1776 that somebody had put together at that point in time, which is kind of interesting. Just a quick slide. Let me just quickly go through what happened with tulip mania. So the background here was that you had this area in Holland where the trade was really growing and there was wealth pouring into Amsterdam and the rest of Holland. And a lot of it was getting into the hands of the middle class. So the tradesmen, the people who had looms and so forth, suddenly found themselves with additional money. At the very same time, certain wealthy individuals started trading tulips. Now they weren't trading the flowers, they were trading the bulbs. The bulbs themselves were the investment, because you could plant one of these bulbs in the ground and the next season it will bring out 3 or 4 new bulbs. So it was a form of investment. But the wealthy people were buying and selling these tulips. And so the middle class wanted to get in on this, and they created what they called colleges, but they were actually taverns. And they set them up as a place to go and trade promissory notes on next season's tulip bulbs. So what happens is you plant these tulip bulbs in the fall, and then in the spring they come up, flowers go away, and now you have your additional tulip bulbs. And you could buy these by the ace, which was basically by a weight measure, and people could invest in them. And so what happened was the price of tulips, index price that I've got here, was about 10.5 prior to the planting season. Once they had to be planted, because they have to be planted at a certain time of the year, right after they were planted, the price started to go up and up and up and up until it hit about 200 above the index price. Now, people have wondered for years, why did tulip mania end? What caused it to end? And what we discovered was that was exactly the week that the sprouts came up in the spring. So you basically would leave your house that morning and you would look out across the miles of fields and see millions of tulip sprouts sticking up out of the ground. That's the first signal that they overbid. There were too many tulips. And the place that occurred in was in Haarlem. And Haarlem happens to be the city in the Netherlands that is the warmest city by far because of where it's situated. And the sprouts come up because of the warm weather. And so it turns out that happened to be the week of sprouting. And it wasn't a coincidence that it happened to be in Haarlem, the warmest city where it occurred. I've got a map here that shows you how Haarlem looks, and you can see all the tulip fields surrounding Haarlem back then. So these people would get up in the morning that week, they'd look out, see all these sprouts as far as the eyes could see, and that day when they went to bid on tulip promissory notes, not one person would bid. They couldn't sell one that day. And that was the beginning of the end for tulips. And they crashed. And as you can see, by May, when they finally got around to selling them again, they were back down to where they started from. So there's your boom and your bust. And what you had was sequestered capital. In other words, the tulip bulbs were literally sequestered underground where you couldn't see them. You couldn't go to a market somewhere and see the bulbs and handle them and so forth during that time period. So that's one story. But then we get to the stock market crash of 1929. Now, what's very interesting about this one is
Mania. Before you keep going,
okay,
Yes.
sure.
How does your story differ from Peter Garber's, and why do you think yours is better?
We cover that all in detail in our paper. Yeah, there's another fellow named Thompson, and it's all written out in very explicit form about the errors that they made. Yes, yes.
So you think it's not? There was an element of irrationality, of course. That
We do not.
knowledge.
We do not. We do not.
Imperfect knowledge.
It was imperfect knowledge.
Imperfect knowledge.
Yes.
I misspoke. Okay.
Okay, now if we get to the stock market crash of 1929, as Jim pointed out, we decided we wanted to look into this, and we were trying to figure out where was the sequestered capital, because stock prices, efficient market hypothesis, where is it? And that's when we discovered these things called blind trusts. So it turned out that what happened was that back in the late 1800s in England, they had invented something called the blind trust, and what it was a mutual fund, a closed-end mutual fund, but that was blind. The people who were running the trust would not disclose what was in the portfolio. That was their trade secret. So they would not tell you where they put your money. And so you had no way of valuing that mutual fund based on what was in it or what the prices of the underlying assets were. Well, the British figured out this was a bad idea, and they regulated them so they couldn't do that anymore. But
After they crashed.
But in 1928, some financial innovators in the U.S. thought it'd be a good idea to bring blind trusts to the U.S. Why? Because we had all these middle-class people who wanted to invest in the stock market, and they could sell them a, quote, safe way of investing in the market. And they created hundreds of these blind trusts, took them public, raised billions of dollars, and it flowed into the market. Of course, with all that new money flowing into the market, the prices of stocks went up naturally as a result of that. But more importantly, what happened was you had these blind trusts, and side by side with them were disclosing trusts. There were trusts that disclosed their portfolios, and there were about equal number or maybe more trusts that were blind. So what Jim and I wanted to see was, look, we have a natural experiment here. What happened with the disclosing trusts? What happened with the blind trusts? So one of the mistakes that we think people made was a very simple mistake, was that in June of 1929, the New York Stock Exchange Board issued a ruling. They said, with the end of your next quarter financial statements, all of the trusts have to disclose their portfolios. Now, the end of the next quarter was September 30th. Well, as you can see here, nothing really happened on September 30th. If you look at the stock market, there was no crash on September 30th. And so a lot of people just threw that out and said that doesn't mean anything. But of course, if you're an accountant, you know that companies have to close their books at the end of the quarter, and then they have to be audited. And there's this thing called reporting week. And reporting week occurs 3 weeks after the end of the quarter. And in this case, it was September 21st through the 29th, October 21st through the 29th. That was reporting week. Guess what also happened that week? The stock market crashed. Okay, so this graph is showing how many dollars worth of earnings were disclosed on those days between the 15th and the 31st by these funds. So this is an RDIT, regression discontinuity and time design, that I performed on these 59 trusts. Half of them were disclosing, half of them were blind. And so what you're seeing here are that each dot is the price of one of the shares of one of these trusts before and after reporting week. And you can see that the disclosing trust, and this is controlled, we controlled for the Dow. So as the Dow moves up and down, we're controlling for the Dow. So the disclosing trust basically just followed the Dow. So 0 would be the Dow, they followed the Dow all the way through. But the blind trust dropped 40%. And you can see the variance in prices. Yeah. Virtually all of them were above 0, meaning they were above the Dow, but some of them were almost up to 200%. So, and you can see that variance. And then after the crash, they become very much almost exactly the same as the disclosing trust following the Dow. And so this is...
and that makes sense because they became disclosing trusts. What were blind trusts before became disclosing trusts afterwards.
So this is new evidence.
It is evidence of something, but I'm not sure it has much to do with the theory we were talking about before, where savings is secularly accumulating and all that. Where does that come in?
Okay, so if you look at the literature or the articles and so forth back in that time, what you read is that the investors in these were middle class. This was an enriched middle class from the Roaring '20s. The wealth that accumulated in the Roaring '20s had left a lot of the middle class with extra savings and earnings, from their jobs. And they were looking for a place to invest it. And billions of dollars from the middle class poured into these funds because they were convinced that this was a great way to invest in the stock market and participate in the benefits of the market. However, it turns out that these blind trusts were actually sequestered, so they had no way of knowing if what they were investing was actually a good investment or not.
So again, George, it's the same story as in Tulip Mania. When the middle class comes to the colleges, they come to the taverns, and they start bidding up the price of these promissory notes. It's the same story all over again. It's deja vu all over again.
It seems to me you can tell this story without the savings accumulation thing, just people looking out to make money and not knowing what they're getting into.
You could,
we could,
but what if they don't have any money?
Well, then they can't invest, but you don't need to have too much money to have money to invest, right? You don't have to have a problem of not knowing what to spend. You just have to, not to consume. You just have to have more income than you need for your consumption, and you've got that without there having to be a story about a wedge building up.
So what's interesting is
this, all the time, right?
What's interesting is that this financial innovation, these blind trusts, were actually launched in response to the demand that the stock market had from consumers wanting to invest. In other words, they hadn't been pushing to invest prior to that time, but
Right.
all of a sudden, the middle class had money and they wanted to invest in the market. Where did that money come from? It came from the Roaring '20s with all of the income growth that people had had.
Sure, but we're richer now than they were, forgetting about the recent crisis. So shouldn't we be making even bigger mistakes?
Well, maybe we did. We had a recent real estate crisis that we could
Yeah.
explain the same way.
Okay. So the point is that the richer people get, the more they go fooling around with their investments.
The richer in terms of savings, right?
Yeah.
Right, and I think part of this, the interesting part for me is the idea that there are these investments in what we would, in an Austrian story, we would call these extraordinarily early stages of production, or stages, even be the pre-production stages of production that that are invisible, are sequestered, to use the term that these two like to use, in ways that make it difficult to price them and difficult to sort of coordinate supply and demand in ways that we typically think would happen. And therefore we end up with tulip mania, or we end up with the problems here in with blind trust, where there was no way to know how to price those instruments.
Tulips look like an early stage of production well enough to me, but I don't know why these blind trusts should be considered that. That money goes into who knows what.
Well, most of they were heavily invested in, it turns out a lot of these were heavily invested in utilities, and those are early stage. And the utilities, the utility index was going crazy in prices of those stocks. And because they were sequestered, initially when we started doing this research, we were trying to find the evidence about the utilities, the underlying utilities. But that evidence is so hard to find, you can't believe it. So,
but what we found was that these were the mechanism that was funding the utilities, which were brand new,
So you're right. You're right, George. We were looking for that as well.
Now, I just want to take 1 second and tell you a personal anecdote. So Jim alluded to the fact that I was a serial entrepreneur in Silicon Valley. I founded 4 companies. My last company was recently acquired for $850 million. It was one of the leading accounting software companies on the web. But I was there starting companies during the dot-com boom. And so I was listening to my venture capitalists and other people talk about it. And they were all crazy trying to invest in dot-coms as quickly as they could. But what happened was, because Netscape and Yahoo went public and did so well, everybody wanted to have a piece of the dot-com world. And so immediately, the venture firms were trying to find the next Yahoo or Netscape, and they had billions of dollars. But it was so bad because you only had about 50 venture firms at that time, and they would rate, each fund was about $200 million. Within about a year or two, we had like 1,000 venture firms, with each of them over $1 billion. Money was pouring into venture capital like I've never seen before. Why? Because they wanted to get into the dot-coms. And these dot-coms, of course, were completely sequestered because you have to go through 3 or 4 years of research and development to build the company before you can take it out and make it available to the public. So I saw this firsthand and experienced it firsthand, and saw the amount of money that was pouring in blindly into these things. And of course, most of that money was lost. One of the firms that I was close to at the time returned only 17% of their original investment to their investors because they'd lost, the other 83% of the equity. It was a terrible thing, and yet very similar to what you see here. But what happened was you had this shock to demand because the dot-coms sent this sort of rippling effect out to people. There was an opportunity here. And then the financial innovations came into place to get people's money to put into it in the form of additional venture capital firms. So you had the utilities. Everybody wanted to get into the utilities. They were building them all over across the country. They created these mutual funds as a mechanism to fund the utilities. People's money poured into it to do the same thing.
For example, Thomas Insull was one of the blind trusts that is in our sample, and Insull made so much money. He and his brothers gave themselves an option to buy at 15, and the thing went to the shares of that trust went to 150. And Insull is famously quoted as having said, "I think I'll buy me an ocean liner." And he got a little bit arrogant with it, but I mean, he couldn't believe it either, how much money he had amassed.
Yeah.
Anyway, I have a little humorous thing here really quick. So everybody needs a story. I'm sorry, let me go forward here. Needs a Robinson Crusoe story. So this is our story. So Robinson moves into an area where there are 4 neighboring islands, and he has his own island. He's welcomed by his neighbors. He tells them that he really needs some fishing nets, and he's willing to pay some gold coins for fishing nets. The islanders return to their 3 islands and go to work making nets. Unfortunately, when they all come back with their nets, they realize, wait a minute, I don't need that many nets. And of course, then many of the net builders are laid off. So, it's kind of a story, a way of illustrating how if you have sequestered capital, you don't know what other people are doing. You can't keep track of anybody else. And we had the same thing happen with this last real estate crisis where as the price of houses went up so high, literally tens of thousands of people became builders. And while we may have been able to predict what the big builders would produce on a regular basis, these 10,000 new builders during their 18-month build cycle, it was very hard to keep track of how many new houses were under construction and how much demand there was. And the result was that when that market finally saturated, we ended up with 4.5 million extra houses that there were no buyers for, because during that period of 18 months, when those homes were under construction, there was no way of knowing how many of these people were building and how many of them were going to end up having to be able to sell those houses.
So I have a quick question about this. The finance of the 2008 is the thing I have the most fluency in, being the pro in the room. And the story that I find the most convincing is essentially the Selgin Sumner story, and that is that nominal GDP, nominal spending, or as Hayek said, the spending flow is sort of the operative sort of balancing act. And when that's knocked off, that's where you get the trouble. And I look at 2008, and the story that seems to be the most interesting is that the real estate market crashes in 2006.
Yes.
And yet the rest of the macro environment keeps chugging along.
Yes.
So you've got all these sequestered builders go bust and go back to their other jobs in 2006 and 7 and early 2008, and everybody's and the market economy is reallocating just fine.
But they didn't go back like that. What happened was, it's this sunk cost argument about why you finish it, why things get finished.
Well, yeah, but James,
they should never have been started.
But James, I guess my point is that it doesn't seem like you get the actual things that we care about in a cycle, which is the collapse of growth and the dramatic, and particularly the dramatically rise in unemployment, until you have the contraction in nominal GDP.
Well, because
let me explain. So what Jim's trying to say is that while the demand for the housing starts stopped in 2006.
It did.
Right? If you look at the housing starts, they basically plummeted 2006.
Yes.
But you have to look at the fact that it takes 18 months to complete a house. So even though the new starts dropped in 2006, the builders continued to work. They didn't lay off people. They continued to build to finish those houses for another 18 months, because it takes 18 months to get through the cycle of building a house. And so what you have is the builders did not leave and go do something else. They just stopped building new houses, but they continued to work on their existing houses, which meant we're still buying lumber, we're still buying concrete and so forth for another 18 months. But
I mean, it's not like everybody starts building all at once, right?
No, they don't.
If the new starts collapse in 2006, then there's some houses that just got finished.
Yes.
And there's some that are just about to be finished, and there's some that got started last month, and so
that won't be finished.
Right.
And there are 500,000 of them that won't be finished. Yes.
Yes.
So that's all happening in that time frame.
Yes.
And that unwinding of the overinvestment in the housing sector is unwinding, although prices are higher now than it was then and whatnot. But I mean, the timing of when the unemployment and when the macro environment gets crazy doesn't quite seem like it lines up with what you're saying. It seems like it lines up better with
John, here's
to nominal spending that are monetary in nature.
I don't have a slide of this, but I have all the data graphed out for starts and sales and all of that stuff overlaid on top of itself, the indexes. And what you see is there's a whole bunch of different timing elements there. So one of them is that consumers and people who are selling a house, it turns out that historically, I ran regressions going back, historically, people will not change the price of their house for sale for 6 months. So even if the market has turned and there's no buyers, they will not lower their house price. Okay, the house price will stay high for 6 months. So there's a lag of 6 months. The construction takes 18 months for a construction of a new house. So you have that piece of it. So what you're seeing is all of these lags in the system are having an effect of, yes, there starts to be some downturns, but house prices are holding up high, and the foreclosures haven't started because, hey, my house is still worth a lot of money, so I'm not going to stop making house payments. It wasn't until the house prices dropped, okay, that's when people started saying, hey, wait a minute, I'm upside down in my house. I'm walking away. And that's when the foreclosures kick in. And when the foreclosures kick in, well, that's when the whole thing falls apart.
Well, I'm not sure I'm understanding the mechanism of how the boom turns to bust in your story, or are you on board with Hayek's story?
It's information that turns the boom into bust. In the housing case, one of the key pieces of information that signaled a problem in the housing market was time on the market, a variable that I don't know if anybody's looked at it other than us. Time on the market starts to rise, and of course, then you start to see prices react to that. But until time on the market started to rise, builders were continued to start houses. But as soon as that time on market rises, those new starts are ended, as you would expect.
Yeah. However, house prices continued to stay up for quite a long time after that. And when you see the house prices start to drop, then shortly after that, you see the foreclosures kick in. And when the foreclosures kick in, that's when the house prices really start to collapse. And that's when the recession hit.
So it's an information story. I mean, the thing about this is you have to look for what was the signal. You have to go out there and think about sequestered capital and then look for how it was revealed. And in the housing case, it's time on the market. There started to be for sale signs all over the place, a visible signal. In the case of tulips, it was what? It was the sprouts in first week of February in 1637. In the case of the blind truss in 1929, what was it? It was the reporting week. It was the information about the portfolios. Every time it's the information that causes a correction. It's consistent with efficient market theory.
Okay, let me just bring up my last slide, just a treat, I promise you. Okay, real quickly. So based on our theory, we said, if this is right, then consumers, during the time when income is growing, consumers will have a period of time where they're investing in durable goods. They're going to buy a new house. They're going to buy a new car and so forth. But at some point in time, they're going to stop doing that. So what this is a graph of net consumer investment in durable goods. So you've got, I'm buying durable goods. Those durable goods are being depreciated. So going up, it means we're increasing our investment in durable goods more than they're being depreciated. And then when it starts to go down, it means we're buying less durable goods, but we're still depreciating what we have. Okay, so what you have here are, these are the recessions since 1959, all the way through to the current one. And what we see here is a pattern of, here's your growth in these durable goods, and then you have a period of where it peaks and it starts down, and you have a recession. It goes up, starts down, recession. Goes up, starts down, recession. Here's the one that led up to this last really big one. And here's the most recent one. Jim and I sold all of our stock right here, okay, in anticipation. We're really glad that we did. Now, obviously, a pandemic is going to make things even worse. As you can see, it's really dropped. But we believe that the recession was going to happen anyway, simply because people had over-invested with the low interest rates, put too much money into the market, and particularly into some stocks that shouldn't be valued as highly as they are, stocks like Netflix and others, you could argue. But anyway, so this is net consumer investment, durable goods. This is a indicator. All of this was produced using data from the government, BLS, VEA, and
so the peaks in the durable goods purchases, when they turn, why do they turn?
Well, because
so we believe that's the point at which investors have sort of saturated their purchase of durable goods, and they're now putting their money into some investment, something that they think is going to bring them a higher return, whether it's real estate here, whatever it might be here, .coms, whatever, back here, whatever. So at this point, if you look at what happens here, the savings actually skyrockets. So you get about 6 to 9 months or more of high savings, and then the crash.
I remember talking to Steve about this, and Steve said, well, I don't know if I believe you guys, but I'm glad you're putting your money where your theory is. And we did, and we bet our money. We took our money out of the market. We took it out a little bit too early. We were out June of 2019, but man, were we glad we were out.
Anyway.
Are you still glad? Have
You
seen
betcha, you betcha, you betcha, because I got back in, I made about 25%.
All right.
Yeah. Anyway, you can look at any variable there is out there, and it will never look like this. You will not see anything that even looks close to this. The conference board's leading indicator, which is a contrived indicator from 10 different variables, and which is calibrated every time they're wrong, it doesn't even look this good. So we're pretty happy with this result. We think that we went looking for this and we found it. It was expected on our part.
George?
Well, the downturns, the business cycle contractions are defined by a number of spending variables as well as several others. And I think you'll find the same switch. It slows down and collapses for total investment spending, for example, and of course for total GDP.
Yeah, but it's not a leading indicator. Unfortunately, it always happens right at the same time as the recession. So by the time the government reports it and you get it 3 months later, it's too late.
No, well, they wait for a couple consecutive quarters of declines and then they report it. That's right.
Yeah, by then the recession's already hit.
Yeah, but
this one gives you 6 to 9 month lead time.
Yeah, we've kind of veered though into investment forecasting from the.
I know. I would just thought that'd be fun.
Yeah, bank if I can. Well, I am not. You know, my overall concerns are first with the kind of secular story that's underlying your original theory, and whether that really either is necessary or coherent. I can understand a story where there's some new innovation out there and people all go scrambling for it, and this sets up a situation with Sequester Capital where things often, or if not inevitably, go sour without any need for secular appeal to a wedge getting bigger and bigger between savings and consumption. First of all, because that wedge just can get bigger forever in a healthy society.
Yeah.
Consumption ultimately does keep going up, but it doesn't have to go up as the same proportion of income. And so I think that if you are thinking of the representative agents, you can imagine that in any given steady state, there's no such thing as a lag of spending behind consumptions for people as a whole that you can motivate for an individual getting used to higher income, you know, when it's a new thing. So that part of the story seems to me troublesome and perhaps otiose to the Sequester Capital thing seems something you could appeal to without it. The other thing I would resist if I were you, because I know it's really tempting, and the Austrians, of course, have set a bad example, is to try to make your theory a theory that fits every cycle ever in the world, as if we only needed or could use one theory that fits them all. That's being too hard on yourselves. If your theory explains a few important episodes, that's itself a very important contribution. But it also could lead to you trying to pigeonhole it into cases where it's really a stretch. And that
well, yeah, I guess you're right. I mean, the first paper we wrote, we quoted Steve Horwitz in an epigraph, where he talked about exactly this problem with the Austrians, that they had tended to try to apply this theory to too many incidences.
Yeah.
Scott Sumner in the mix now.
And so we we agree with Steve completely.
Well,
Yeah,
Yeah, in fact, I would say the
make it sound
2001.
like you're excluding all other theories for all other episodes that you don't address.
Right.
And so I would resist trying to oversell it. But I think the thing that worries me more is the mingling of a secular over savings or under consumption theory with a cycle theory.
Right.
I'm not sure they work well together.
And I think that you don't to sort of take that one more step. I mean, one of the reasons I like the paper on the blind trust, I like it enough to have my name on it, is that in and of itself, it stands alone as a piece of economic history, right? It doesn't require that there be any larger, that story be applicable to other kinds of things. Might be, might not be. But standing on its own, it's a great story about why the market turned when it did, and what was the nature of that sequence of events. And so, for me, I think George is right that it's not you guys, us, however we want to think about it, have an important insight here, but I don't want to drive it too far. For the same reasons that the Austrian cycle theory can't explain every cycle.
Well, let me just say that we definitely don't think that the story of the consumption is necessary. And we would look at 2001 recession and say that was more of a real business cycle explanation there because of the attack. So there are recessions that occur for a variety of reasons. They don't always have to be explained by our theory. However, I just want to say that I used to own a ranch in Arizona, and I had national forests on 3 sides of my ranch, and the government would not clean up the underbrush below the trees, and I was very concerned about a fire. And so I basically threatened them, and they cleaned it all up for me. And during the time I owned the ranch, I never had any fire problems. I sold my ranch to a state senator who put his horses up there. About 6 years later, he called to tell me that the ranch had burned to the ground, everything was gone. And I said, well, did you make sure that the underbrush had been cleaned? And he said, oh, was I supposed to do that? I didn't know. And so what I guess I'm trying to say is you don't have to have the underbrush for a lightning strike to start a fire. But if that underbrush is there, it can make things burn a lot brighter and a lot worse. So what I'm saying is in a period of rising income, where you have this variation from consumption and savings, where savings would be growing, to think of it as underbrush, if you will. Then if there's one of these events that comes along with the Sequester Capital, there's just more capital to flow in. That's all.
Yeah, I think that in that case, it might be useful to distinguish between periods when income is growing at an unexpectedly high rate versus just the fact that it's growing and then we're getting wealthier in a secular sense. In that case, even though it can be rapid growth, if it's a trend growth, there's less reason to think it would give rise to your story in the aggregate.
Right. Yeah,
So
I agree.
Scott, are you able to hear us? Or
We saw you briefly, Scott, and now we don't see you anymore or hear you.
He's got everything turned off, so.
Oh.
I see he's not muted, but he's having some technical.
He's a voyeur.
He was shadowy when he made an appearance.
Not a voyeur.
Anyway.
Well, has this feedback, guys, been fresh or what's the?
Hey, don't call me fresh.
I know you're fresh, George.
Oh, it's very useful to us. You know, we've been working in a quiet little set of offices there at Ball State for the last few years on this. Spent a lot of time gathering data and so forth.
Well,
so
Steve's been beating up on us, and so it was nice to have somebody else beat up on us.
I came here to eat popcorn, man.
No, I mean, Steve was very
like a former freshman dishing it out to the newbies because
Steve was
by his own.
No, Steve's been very frank with us all along, and without that kind of feedback, we wouldn't have gotten very far at all. I mean, we can't. We can't.
So
we like criticism. You know.
I just want to say that we don't call this sticky consumption theory. We call it sequestered capital theory because we're really focusing on those instances in which you have sequestered capital that is behind this. So keep it.
Yeah, and I do think, I mean, I had, when we kind of put this together, I hadn't reread the sticky consumption paper that sort of started this all for a while, guys. And reading it again, I think they're separately, perhaps from the other things, the sequestered capital stuff. That's an interesting paper in and of itself, in the way that you play with Garrison's model, and presumably that Garrison found, constructive enough to think, okay, this is interesting. So that, I mean, I think, again, it's funny, when we first started this conversation, over my other screen here, I pulled up a Word document and I wrote sticky consumption and skipped 2 lines and then wrote sequestered capital, and thought we got to make sure that we keep those 2 points are just distinct arguments. There are some of the work you've been doing where I think they overlap. As you said, what's lighting the fire, or what's the tinder. But I think it's important to remember that those are 2. You don't need both of those to tell the kind of interesting historical stories that you guys have been telling.
So, Scott, we can see you now. Can you hear us?
I think you're muted.
We can't hear you.
We're not hearing you, but you're not muted on the software, so it might be that your headset's not quite plugged in right. Now you're muted.
Now you're definitely muted.
Yeah, I had a student with this problem today during my virtual office hours who had to go to the control panel for sound and switch it to a different microphone because Microsoft has several different microphones that they have in their system, so it might be related.
I'm gonna try my best to channel things I've read from Scott as a counter example.
Can you hear Scott? Nod if you can hear us.
Yeah.
So he can hear you.
So just to
He
summarize,
can't correct you.
I as the translator role, Scott, they're fundamental. Let me see if I can pitch your theory to Scott as an exercise. So and let me know if I get it wrong. So what they've put forward is a theory in which rising savings will depress interest rates in the loanable fund, through the loanable funds market, supply of loanable funds, and that those lower interest rates in the face of increasing savings will lead to a chase for yield, looking for better and higher rates of return. And so that search for higher rates of return will lead to earlier stage, higher risk, higher reward investments, and that there is a class of that kind of investment. You could call it like seed funding in Silicon Valley, or other kinds of investments where there's not a lot of information. They're very opaque as far as what's happening inside of it. So if you've got a lot of savings, you've got low interest rates, you're going to see money flood into seed startups who are in R&D. They don't have products, they don't have revenue yet, and so this is a high volatility sector. And when these investments start to come to market, you get the outcomes. The information is revealed that leads to the crack up. So that there's a kind of structural shift of investment into high volatility, low information investments that produce instability. Is that a?
Well, it's uncertain. I mean, risk has that different meaning from uncertainty, and so I think it's more uncertain than risk.
And yeah, the real estate derivatives are a good example of this, where nobody could unravel those things. Who knows? But people always believed that real estate was a great place to invest. So I'm buying derivatives. They ought to be the safest place to put my money. But there was the way those things were structured, you couldn't possibly know where your money was going. And so they were sequestered. And of course, when the reality of the loans that were behind those derivatives hit, and we discovered that in fact they were bad loans, way worse than anybody thought, then we saw the collapse of the derivatives.
So the part that I've observed from from Scott, I feel like I've read this from Scott the most, is the focus on Australia as this interesting monetary counterexample in business cycle stories of 25 years without a technical recession and relatively stable nominal growth over that time period. And I think Scott's story, and perhaps
I
George
think it's
also
David Beckworth has written a lot about that besides Scott.
Okay, yeah. Well,
David.
Can you hear me now, by the way? Or?
There we
Yes,
go. There he
yes,
is.
yes, we
Yeah, but
can.
we don't need you anymore. John's coming in.
I apologize. I'm not very good with tech.
We have a
I
surrogate.
finally figured out the sound, I think. But yeah, Australia's an example. Maybe I'm missing some things since I jumped in late, but my basic framework is that there's sort of a monetary cycle that drives nominal GDP, and that's the main thing with the business cycle. And other stories that are about investment are either microeconomic stories where there are specific industries that run into trouble, or perhaps there's such a big problem in the investment sector that it crosses over into large enough to be macroeconomics for what Arnold Kling calls reallocation reasons. So you invest way too much in one area, a mistake was made, resources have to be transferred somewhere else. And during that reallocation of resources, you have a period of unemployment. In my view, that's pretty rare in a large diversified economy to where that rises to the extent of being an entire business cycle, but it's theoretically possible. So that's sort of the framework that I work with. And yeah, Australia is an example of a country that kept nominal GDP growing at a decent rate for 28 years or so, and until the COVID crisis hadn't had a recession, technical one.
To be fair, though, the Australian economy, as I recall, has only grown about 0.5% a year for the last 28 years. I wouldn't really call that a robust growth. Right?
No, I think Australia's grown faster than the average developed economy. Although some of that's population growth, I don't know the per capita.
Yeah, I think the per capita is only about 0.5%.
For 20 some years?
For about the last 20 years, yeah. I could look it up again.
I'm not sure about that. I'd have to double check that. That sounds a little low to me, but I'll have to look at the data. I will say this, Australia has been, during the so-called neoliberal era from, say, the 80s to today, it's generally been viewed as a developed country that's done better than most other developed countries. You know, its ranking against, say, European economies has been rising over that period. It's been gaining in terms of per capita GDP relative to other developed economies since maybe the 1990 or so.
A quick look at the World Bank's GDP per capita growth in Australia. Actually, it's been pretty all over the place, all positive, but well over 0.5% per year. That 0.5% number seems more accurate for the last decade, maybe, but certainly going back farther than that, it was greater.
I see. Thank you.
Mm-hmm.
Yeah, right. It was more about 1.5%, and then the last last decade it's been about 0.5%.
Yeah.
I lived in Australia for quite a few years, and you also have to consider Australia. The Australian people are very different than the American people. It's a very different society. I love the Aussies, and I have many friends there, but I just don't see them having the same reaction or response to investments and things the way that we do here.
it seems like there's like a price. So you're a way I'm interpreting what you're arguing for is that it's the increasing share of capital of investment in a unpriced sector, right? Is that the fundamental mechanism that it's going
Yes.
into a zone where the price mechanism, the
Yes.
market prices are no longer playing an allocative role? Is that
right? Hayek always was put off by these these disproportionality theories. Hayek was very put off by that kind of thing, and he wrote about it. And he said, "Well, I can't understand." He says, "You have to explain to me why it is that these people wouldn't be able to observe one another's preparations and react to it." And the answer is, he's right across the stages of production, but the stages of production are a subset of the structure of capital. And if you want to do capital structure theory, macro, you got to include the pre-production, what Steve Horwitz called, and correctly, what he referred to as, there's pre-production stuff. There's pre-production research and development, and as David knows, that stuff is deliberately hidden. These guys doing that work are hiding it from each other. They're not going to reveal that. They're signing their employees, as I said earlier, to employment agreements where they have to keep their mouths shut.
What do we know about the share of total investment that ends up in R&D at any given time in the United States?
Well, first of all, you have to define what that means. So you have the classic research component of it, which obviously is very well hidden. That's when everybody's doing all the research. And that could be very large, in the case of the drug companies and so forth. But then you have also the development stage. And the development stage, for example, when Apple's producing an iPhone, it's a brand new product. Nobody knows about it, right? They have to keep it secret. They have the research and the research piece of it. The development phase is producing a prototype, right? Prototypes that work. And then they have to develop the initial inventory. And the initial inventory could be 500 million iPhones in boxes ready to ship. And all that's produced before anything hits the market and can be priced. So we're talking about a large amount of money that is tied up, large amount of capital that is tied up, because once it actually hits the market, then it starts generating profits and so forth, and the capital investments can drop lower. But the same thing with the drug companies, or even somebody like Microsoft producing a new product, a software product. The thing is that that's one example, right, of where you could have a form of sequestered capital, the research and development. But you can also have it in something like housing, where you have a shock to the demand for housing, and 10,000 new people become builders. Well, they have to go through the research of, okay, I'm going to have to learn to build houses here. I'm going to have to go get permits. I have to buy land. I have to dig foundations and so forth before any house ever hits the market. And there's 10,000 builders doing that. That would all be research and development as well.
Some of them presumably built a house or two before, though, right?
Well, we hope so. I have a nephew who hadn't, and he decided he could become a builder.
Yeah. Well, remind me let me know when he's at a few houses under his belt.
Oh, no, he gave that up and went back to school. He's now a nurse anesthetist.
Uh-oh. And how many people has he anesthetized to success?
Scott and George, do you both think that this capital structure macro is bullshit? Your stories tend to not focus on it at all.
That's too broad.
Wow. Bullshit's too broad of a term.
I think Scott might think it's bullshit.
No, I think.
Go ahead, Scott.
Well, my view of all of these is that not just these two theories, mine and Austrian views, but Keynesian and others, is they're looking at a complex picture and focusing on different things. So if I wanted to defend a model I don't agree with that's based on investment cycles, I would defend it this way. We've had throughout American history both a gold standard and a fiat money system. And both systems are run in such a way that exogenous investment shocks tend to trigger monetary shocks in the same direction. So if there was a railroad boom and bust in the 1800s or a tech boom and bust in 1999, it interacts with a monetary system for different reasons, by the way, in a way that moves monetary policy in an overly expansionary and contractionary direction along with that exogenous investment shock. So, I mean, I focus on the monetary policy mistakes as the so-called cause of the business cycle. But if you wanted to take the flawed monetary system as a given, you'd say, well, then if we allow these investment shocks, they're going to interact with our monetary system and produce big fluctuations in nominal GDP growth, and that'll trigger a business cycle. So you can tell a story with these exogenous investment shocks, if I'm using the right term. It's just not the one I would focus on because my interest is in fixing monetary policy. So I tend to sort of focus on that as a causal factor.
Well, Scott, I think you can go a step further. It's not clear what policy can fix these investment shocks. I mean, somebody doesn't know how many tulips are going to sprout, and there are a lot of people are putting money into it. How are policymakers going to fix that phenomenon? I don't think they could do much about it if they tried.
But interestingly, Hayek cites in a footnote in his monetary theory book, he cites Morgenstern, and he lauds Morgenstern for calling for increasing information by companies about what they are developing. Exactly the kind of thing that David and Steve and I are talking about.
Well, I guess you could have them divulge more information. That's true.
But Hayek seems to, my point is, Hayek seems to have sort of been almost right there. I mean, he was that close.
But he had his own theory he was working on.
Yeah, Hayek never, and we know what happened to that theory. Yeah. We know that theory got crowded out, and we know why. Because he didn't finish the pure theory of capital.
Well, one of the concerns that I have about the money piece of this is tulip mania was completely funded by the middle class themselves. In other words, they wrote notes to each other. They created credit with each other. You know, I'll buy this from you. Here's a derivative. Here's a note. Here's a future. You know, buy your futures, and the real estate derivatives, in a lot of ways, were a form of money that was being created in the market. Now, admittedly, Sallie Mae and Freddie Mac were pouring money into those, to help. But there was a lot of money going into these derivatives that really had nothing to do with the Federal Reserve. It was money that was being.
But it doesn't have to be the Federal Reserve. If we go back to the gold standard, for instance, if you think of there being, say, an exogenous investment cycle, when there's a low period of investment, the natural rate of interest will be lower. And there's models that show that under a gold standard, a fall in the interest rate is deflationary for the economy because it essentially reduces the opportunity cost of holding gold. So there's increased demand for gold, and that's deflationary. And those models fit pretty well into the gold standard. The price level the price level follows the interest rate pretty well. Whereas if you looked at a Fisher model, it's supposed to follow, interest rates are supposed to follow the rate of inflation. So it looks like under the gold, what's that?
You're talking about the Gibson paradox, right?
The Gibson paradox. So the fact that the
what's
price level
Gibson paradox? Like for the non-economists,
correlation between the price level and the interest rate.
Right, the price level. So the models that I find most persuasive on this is that, let's say the railroad boom ends, so there's less investment, so the equilibrium interest rate falls. The Fed doesn't even exist. Okay, so we've got an equilibrium interest rate. It falls. That increases the demand for gold, and since gold is the unit of account or the medium of account, that's deflationary. I mean, you have essentially a fixed amount of gold in the short run. So if there's more demand for gold, the value of gold goes up. And since we're on a gold standard, the only way for the value of gold to rise is for there to be deflation. There's no one like the Fed to short circuit that process. So although the long run price level was stable under the gold standard, it did go up and down with interest rates, and those interest rates were not Fed policy. They were just fluctuations in the business cycle in the United States. Now, once we get to fiat money system, the Fed is pegging interest rates, but that's also pro-cyclical. Now, if there's a big investment boom and you're pegging rates, well, you're holding them artificially below the natural rate, so you create excessive monetary conditions for that reason. So ironically, we have two different mechanisms, but both point to investment interacting with monetary policy and triggering instability, both under gold standard and under fiat money.
It's not clear, Scott, that the central banks weren't contributing to the Gibson paradox themselves. That is, that it was the combination, maybe if they hadn't been doing their thing back then, we would have seen less of this cycle as well. Because they could
even before 1913, though, in the U.S., or?
Well, you could still have central banks trying to stabilize interest rates to some extent in that system and contributing to the problem.
But the contribution of sequestered, bringing it back to what we want to talk about, the contribution of sequestered capital is that it provides you insight into the timing of the turn. It's information, and these other theories do not do that.
See, but now you're back to doing what I think you shouldn't do. We should absolutely be looking for explanations of timings of business cycles. We absolutely should be looking for it. Hayek was looking for it. I know, but what I'm saying is, when you're dismissing the other theories,
I'm not dismissing. What I'm saying is that those theories don't provide you with an explanation. They don't provide you with insight into the timing, and this one does. So why aren't you embracing this?
But that doesn't mean it doesn't do other things, right? I mean, that.
Yeah, it depends on whether, again, it's a question of whether you think your theory really is a better theory for all cycles.
It doesn't have to be better for all cycles. Well, as David said, 9/11 happened, and we wouldn't claim to explain that. Who would?
Okay, well then there's a theory for that, isn't there? And that's one of the theories that your theory doesn't do a better job than.
Exactly, absolutely.
You can't have it both ways.
No, we recognize that. All we're saying is that there are certain types of business cycles in which people are investing in sequestered capital. If we recognize that, then we could look for the timing of when the information is released and say, look, in this particular case where there was sequestered capital involved, when the information was released on the market, then there's going to be a correction.
Yeah, our point is that we are pushing back against the irrational exuberance explanation of a lot of phenomena. We're trying to push back on that.
And it doesn't have to be the case, but it can be the case that monetary expansion is the underlying trigger for the investment in that capital, that in the sequestered capital, and the unsequestering of that capital explains the turning point of that particular cycle. But again, there's other stories that one could tell here too. I do think, the conversation today has been fun for me because it's been some of the same things that, again, I've been pushing back at these guys for a few years now. But I do think there's something to that sequestered capital point, how much and which stories it fits.
Yeah, but this is back to Friedman and his criteria for what makes a good theory. I mean, it's simple. According to Friedman, and I guess I'm arguing from authority, it's simplicity and its consistency with the factual evidence and its fruitfulness. So we're going to have competing theories. How are we going to do that? Well, Friedman's got a good set of criteria there.
But you don't, Jim, you don't need to have, but there's a difference between competing theories, any one of which could explain everything, and competing theories, some of which explain some things and some of which explain other things.
We're not trying to explain everything. We're trying to push back against these irrational exuberance guys. Like for years, they've been talking about tulip mania. They say, oh, it's irrational. It's irrational. No, it's not.
Say that when Peter Garber wrote a book all about how it was rational, and that's what.
Yeah, but Garber got it wrong. And read our paper.
He didn't, but you just described the conventional wisdom.
Look, Schiller's
was irrational.
Schiller got the Nobel Prize. He writes a book with Akerlof, and he's still talking about tulip mania as his book title is Irrational Exuberance. He's still saying it.
I know they're out there, but
no, they're not only out there, they're big guys.
So is Garber.
Oh, but Schiller, where's Garber's Nobel Prize? It doesn't have it. So
Nobel Prize.
Just a comment real quick. Jim and I, when we were doing our 1929 paper, we had a confrontation with the 1991 paper by DeLong and Schleifer.
Yeah.
Because they had put out this paper that I think everybody's read. I think at some point in time, one of our classes, where they explained the 1929 collapse of the closed-end funds. And they had two empirical components to their paper that they provided as evidence, which Schiller has used to defend his position. And one of those was a study on AES, American European Securities, and the other one was a look at 10 IPOs of investment trusts at that time period. Now, the challenge we had was, how can we write our paper and make this case while their paper is sitting out there with these irrational exuberance components? So we spent a summer, 3 months, Jim and I and another research person, and we went through and rebuilt and reconstructed from scratch all of their work. Only this time we have better tools. And we were able to show that, in fact, they got it out completely wrong. AES was wrong, and all 10 of their IPOs were wrong. And we have the data to show that, in fact, everything they produced that paper was incorrect. So that was a lot of fun doing that. That then allowed us then to make our case that, in fact, it was the blind trusts that were sequestered that was the cause of it, and not just the trusts in general.
Yeah. No, I mean, I get it. And I think that when you take these individual cases and you fit them, and it does a lot better than extant stories, that's fantastic. That's wonderful. I think there's still room in the world for Hayek's theory, for Friedman's plucking theory, for the Scott Sumner NGDP theory. I think they all have episodes that they can help us to understand that appeals to, I suspect, appeals to sequestered capital will not explain a lot of some of these episodes because it's just not a big deal in those other episodes.
Sure.
And that's all I'm saying is that we shouldn't even, Hayek's theory, for example, the discrepancy between natural and actual interest rates that Hayek and Mises too build off of, with the capital story that goes with it, which is it's distinct from the Friedman and the Sumner theory. I think it has applications. And of course, in a lot of these episodes, probably 1929 is a good example, you can take all these theories and explain some parts of them. And you can't explain everything that happened. Even with all these theories, you probably need some more stuff as well.
Which is why, I mean, these guys have heard me say this, and I think we're there finally, but which is why that paper on the 29 trusts, to me, is most powerful as not as a story about business cycles or efficient market hypothesis in general, but a story about that particular cycle.
Well, part of that cycle, though.
Yeah, right. Yes, part of that cycle. Right.
Everything that happened particularly before, or the low interest rates that the Fed set, and
exactly
as part of the story, as Scott has emphasized, there's a lot of stuff going on that's
and particularly interesting about its relationship to the timing of the stock market crash. And
of course,
David made earlier about when the information actually became available, right? And that, to me, that very precise slice of the story is really interesting. And I think, as the last thing David said, has, that paper has DeLong and Schleifer. I mean, their paper can't hold up in the face of what we've done.
I have a philosophical question for the group. How does falsification work as a tool in any of this? So like what I mean by that is if the secular part of the story that these guys have told is that you have this shift into a high growth economy. I guess I asked James this before. I said, well, shouldn't China have a much more volatile business cycle with more frequent booms and busts, given high savings rates and high growth? And wouldn't the failure of China to have a more volatile business cycle be falsification of sequestered capital as a general theory? Is that not true? Is that a bad example?
I think that whole secular story, first of all, has to be set out in a coherent way to see if it works macroeconomically at all before we start worrying about whether China fits it or whatever. I'd like to see, exactly why there should be periods separate from the question of new inventions, which we've already said could be disruptive in themselves. Well, I'm not sure. I'd like to see the coherence of it before I go looking for, because otherwise what happens is you get people saying, well, this fits this, and that's worse than falsification. That's verification, and it's not compelling.
I think we're back to John's question about whether capital theory is just bullshit. I mean, because one of the big problems with it is that Mises's theory is different from Hayek's, and Garrison sided incorrectly with Mises's theory. So you can't just.
Why is Garrison? I found Garrison to seem like he made a lot of sense, but
well, he did. That's why for about until David showed up, I was fine with teaching that. And
what's wrong with it?
The big problem with it is it has consumption highly volatile over the cycle, and that is not true. We have sticky consumption, and if you look at our sticky consumption paper, you'll see that, in fact, our cycle. It turns counterclockwise and it's flat on consumption. Hayek was right. Hayek had observed that it's investment that's highly volatile, not consumption.
Right. Mises is that you have consumption and investment both being driven past the frontier. Is that what it is?
Yep. And Garrison likes that because without sequestered capital, that solves a problem for him.
Well, when we presented the information,
yeah. So, I was going to say, I thought Garrison always emphasized that it's a malinvestment theory, not a over.
It is absolutely. It's a malinvestment theory because for the same reason that Hayek could never understand how there could ever be an overinvestment.
Okay, but then
look, Garrison, when we showed the information to Garrison on sticky consumption, the empirical data, his comment was, "Oh, I had no idea. I didn't realize consumption was sticky." Now, I was a little surprised by that, but that was his comment. And if you look at his graphs and how it works, the theory relies on consumption, demand for consumption rising on the other side, and if consumption is sticky, you're not going to get that at the same time.
I thought my totally grasping through the stuff, trying to understand what these stories were that made sense when I looked at the world was that you have when rates are artificially low because of easy credit conditions, that you'll get malinvestment in interest rate sensitive sectors, early stage sectors, and that what turns them from boom to bust is rising costs relative to what you can get on the market. So you saw in late stages of the housing boom, concrete sales costs going through the roof, and people ripping copper out of job sites because copper prices, or all of the prices of the inputs, were going crazy because of demand.
Well, that would be inputs, but in his model, he shows that with the interest rates coming down because of the money going in to savings, that the consumers pull their money out.
So this
pull their money out of
consumer credit, rising consumption because of easy
Right.
credit,
Yes,
like
yes,
credit card,
yes,
low credit.
yes.
People
Yeah,
are
and that part just isn't right.
interesting.
That's not the Austrian theory I know and don't necessarily love.
I was waiting to see how you were going to finish that sentence, George.
I've got to go, fellas. I know it's not quite 5:45.
That's all right.
I've got a pile of stuff I've got to deal with.
But thank you, George.
Thank you,
At
George.
all. Thanks for letting me put my. It wasn't 2 cents. It was probably
I learned a lot.
too much.
It was at least $1.50.
$1.50. Yeah. Anyway,
So George,
appreciate it.
in signing off, what's your favorite, most broadly applicable story?
A story of what?
Well, I think all macro theories are kind of stories. So but like,
Most
what's
applicable macro story.
Yeah. Is it nominal stability?
You're talking about what do I think is the main cause of instability, macroeconomic cycles and instability?
Yeah. Even if there's not a perfect one that fits all cases, what's the
my position is very similar to Scott's. Without venturing to claim that it's the cause, I think the most important thing government can do is stabilize aggregate spending to smooth cycles. Certainly it's not going to prevent manias in certain markets, especially. It's not going to do that. But I agree with Scott that if those, depending on the size of those markets, that the macro consequence of the disruptions might not be too bad, but there are other things the government can do, like get the information disclosure better that you guys were mentioning, that might be the right way to deal with that. So, but my like Scott, I'm focused on policy. That's so, you know, everything's everything's a nail if you got a hammer, and for me, everything's about what should the central bank do or not do. So that's why I like that story. And I have to say that I think if you have a stable nominal GDP story, if you think about the cycle as a dance of nominal GDP, not of the dollar in Fisher's sense, but it's close. You really can dispense with or fold into that a lot of the Hayek stuff with interest rates and VIXL, and just say, yeah, some funny things are happening to capital when NGDP grows too fast or too little, but then who cares? We already care about some of the more obvious consequences of that. So we deal with the secondary consequences by preventing it as well, but why look into them so much and obsess over them, because it doesn't give us any different advice. That's my kind of practical take on all that.
Thanks, George.
Scott, before I cut off, I want to say, in writing my things on the Great Depression, two things are true. One is I've learned a lot from your book. Another is that I haven't cited it quite as much as I should. Sometimes I've got piles of stuff in my apartment, and in every essay I write, I find I only refer to about 5 of the things I read because it's too much to try to go back and look at them all. But sometimes I go back later and read and say, oh, Scott said all this stuff that I could have used. Anyway, it's a very, very, reading it again, it's a very, very good book, I have to say. I think it's got a ton of great stuff, and that if everybody read it carefully, they wouldn't have any use for most of my essays. But I'm counting on the fact that a lot of people haven't read it carefully. So
I'm hoping you'll write a book, because you can explain these things in a much more accessible way than I can, so it'll have more impact.
Your book is more involved and intricate, so that does give me a niche market. That kind of thing discourages a lot of people, so I can take it.
George, those alt-M posts there's a book there. That's my
I'm
first
glad
reaction.
you appreciate it. I wish I got more good comments. I'm only getting crazy people on my all 10 comments. I get now only 2 or 3 comments, and every one of them is from a freaking nutcase.
I'll start commenting on them, George. I've seen.
Yeah,
they've been great, George, and they will get used. I'm supposed to teach American economic history next semester.
Have the students come in and they can comment and stuff. I envy Scott. He's got 3 or 4 regular nuts on his comment. And he's very patient with them. And actually, he can insult them. They won't go away, these people. They like it.
Well, that shows you how nuts.
But he has intelligent comments. Oh, my God. The thought of getting intelligent comments on my post just, it makes me so jealous. Scott, you have no idea.
The grass always looks greener on the other side. Trust me.
I mean, there's some of them are pretty. You have some smart people. Anyway, I gotta go.
Yeah, I gotta go too.
Talking to you all, John. Thanks for setting this up. I hope other people got something out of my big mouth.
Well, for me. It was just a pleasure to spend some time talking about this stuff. I mean, I talk to these guys all the time. But to sort of to broaden that conversation, and so John, this was great, and just given how all cooped up all of us are, an opportunity, and that technology is marvelous for making this possible to have the conversation. So I want to.
Yeah, I mean, being cooped up probably got me to be a little cranky, George. I mean,
no, Jim, I was thinking you were less cranky than you usually
Hey,
are.
what makes you think I'm always like this?
I was waiting for the Jim and George show was going to be the highlight.
John, David, everybody, Scott.
Yeah.
All right.
Take
Thanks,
care.
George.
Thank
Thanks.
you all
Thank
later.
you, guys.
It's good
Thank you
talking.
again, John. We'll see
Bye-bye.
my colleagues. I'll see you sometime soon.
All right. Thank you.
All right.
Thank you,
Thank you.
Steve.
See you guys.
Thank you.
All right. So
Let me say one thing before I forget. The stuff on pushing back against irrational exuberance, that's music to my ears. I've been very strongly opposed to those non-explanations for things. I've written some on it. I have a book coming out early next year on my views on monetary, and I have a whole chapter pushing back against that kind of ad hoc explanation for things.
well,
I feel like usually they're explaining it with irrational exuberance because they haven't looked closely enough at what's really driving different sectors.
Yes.
I've never understood the Minsky or Schiller style arguments that seem to presume a lockstep societal coordination that has no mediating agent other than contagious, and I'm looking for the virus that that spreads sentiment. I mean, at least give me like a mass media explanation or something, like the rise of the newspaper, because in the absence of that, what's the contagious mechanism for these sentiments? I don't get it.
But
For every long there's a short. I don't get what the
When we were doing our investigation into this, we came across one particular IPO that DeLong and Schleifer had listed, where they said that on the day of the IPO, this closed-end fund has actually gone up by 103% that day. Now, when Jim showed this to me, my reaction was, that's impossible. Nobody is that stupid that they would invest money in a mutual fund on the day that it's launched and pay 100% above the money they're putting into the fund. Nobody's that stupid. It's got to be wrong. So when we started getting into this thing, we discovered that that particular fund had been pre-sold 20 days earlier and was sold to firms for their stock. So they basically started on the IPO date fully funded with shares invested.
and after a period of time during which the shares rose in price.
So during those 20 days, it turned out that those shares had appreciated by $16.50 a share. And it was disclosed in the newspapers before the market opened that in fact the shares had appreciated by $16.50, so that when the price came out on the market that day, it was up $16.50 a share. Okay, so
this is an example that Galbraith had highlighted in his book, The Great Crash, and similarly, DeLong and Schleifer then followed suit and used the same example, the Shenandoah Fund, and
they were just sloppy.
Right.
You know, they were looking for irrational exuberance, and they found it. But if they'd really been digging and really looked into this stuff and read the prospectus and evaluated all the things that happened like we did, they would have discovered that, in fact, it sold for about 2 or 3% below its book value on the day of the IPO. I love it.
Scott, you like to bash bubbles as a theory. And these guys have taken a close look at the sort of information disclosures at the heart of the tulip mania's crack up, and which is like the most popular bubble story ever told, right? Is the tulip mania. Mm-hmm. So I think you weren't on when they tracked that story, but what's your, have you looked at the tulip mania? What's your
a long time ago I looked at the Garber book, but I don't have a real strong memory of it, I'm afraid. So I'll defer to their more recent research on that.
The problem that Garber had was that he tried to say, well, you know, these prices that they're quoting were not actually the prices of the shares, and of these tulips, and they got the prices wrong and so forth. The problem is, if you really dig into it, through Dash's book and others, he only had one piece of evidence. Garber had one piece of evidence where he could show, look, this was not correctly cited. But Dash in his book has hundreds and hundreds of documents showing that the prices actually did go up during that time period. What we're trying to say is that, of course, they went up because the tulips were in the ground and nobody knew how many there were and nobody knew how to value them. And so based on that and the fact that they were selling these derivatives, futures, on the prices of what was going to come out in May, they had no way of valuing them because they don't know how many there were. And when the sprouts showed up the first week of February, they immediately saw that there were way more tulips than anybody believed there was going to be, and the price collapsed. So they had a signal.
And I think if you look at a lot of the episodes that are called bubbles, they're often things that are intrinsically difficult to value because there's an enormous amount of uncertainty. A couple quick examples. Bitcoin's an obvious one. Yeah. Bitcoin's a product that's very difficult to value. We don't have traditional metrics. Another one was tech stocks around 1999, 2000. Now, when the bubble, quote, bubble crashed in 2001, people retrospectively said, well, those prices in 2000 were irrational because they only made sense if you thought that tech companies were eventually going to dominate our economy. And, you know, Apple and Amazon and all these were going to be trillion-dollar companies. Well, actually, now they do. So, but there was an enormous amount of uncertainty. And so the way I look at these price movements that look like bubbles, it's just changing perceptions or changing best guesses in an intrinsically difficult to value asset. And there's nothing wrong with that in efficient markets, that you could have large fluctuations in prices when something's difficult to value.
Yes.
Yeah, but we would argue that the blind trusts of 1929 should never have been allowed to be blind. You know, the New York Stock Exchange eventually figured that out and made them disclose their portfolios. But during the time that they were hidden, that should never have happened, because that lack of disclosure resulted in those high valuations that shouldn't have happened. Now, I don't know how you solve a problem like the dot-coms, because that money was a flow into venture capital. It's private capital. They get to do whatever they want with that. However, the venture capital firms are relatively new, and they're learning. They're not going to make that mistake again.
Mm-hmm.
Yeah, they're not going to be burned a second time, is what I'm saying.
I think in a way, for what it's worth, you know, the difference between what you guys should be talking more, it seems like to me, you know, because Scott, I think Scott's always been interesting to me because of his intersection he's an EMH guy, so he's not talking about bubbles and all this nonsense. And I think that seems like that's the same fundamental story. You're all talking that language, that people are not operating in these weird cycles that are psychological cycles.
No, it's always an information problem, and once the information becomes disclosed and people are aware of it, the prices are going to correct. I spent 25 years as a CEO in Silicon Valley, building companies, and I just saw, the rationality of the market every day. And it wasn't until the dot-com boom, and I went through that with my investors. I had a startup that had just started shipping product to enterprise, firms like big banks and so forth. And it was right before the Y2K thing hit. And they said, we want to get into the dot-com business, and you're an enterprise software company. We want you to reinvent yourself as a dot-com. And I said, I'm not going to do that. And so I resigned as the CEO because I thought it was foolish. So they tried to redesign it as a dot-com, and they almost got away with it, and then the market collapsed. They lost all their money. But I heard a lot of venture firms. The anecdotes I could tell you of venture capitalists, who I always thought were very smart and rational people, talking about the new economy and how you didn't have to have customers. All you had to have was eyes and so forth. And I was like, no, it has to be a revenue model. Google has a revenue model. Apple has a revenue model. You have to have a revenue model. No, you just have to have eyes. And I listened to this stuff and absolutely drove me crazy. But again, it was a situation in which they saw the IPOs of Yahoo and Netscape. They saw the huge amounts of money that were made from those IPOs. They wanted in on the action. They went in, and in parallel, they and another 1,000 venture firms all went out desperately trying to find entrepreneurs to fund, to create dot-coms, and they overvalued them.
Is it the case that, isn't it sort of a weird symbiosis between the notion of efficient markets and the need for a small minority of rabble-rousing, price-discovering risk takers who are always going to be operating at the boundary of uncertainty? I mean, it seems like venture capital looks fairly like a like it's a casino.
No, not at all. If you look at how venture capital firms are structured, they're very carefully designed to deal with risk. So what they do is, first of all, they parse through thousands of businesses, and they'll finally pick some that they think look reasonably good. And they'll provide them with, say, $2 million, some very small amount of money. And they'll say, here's $2 million. This is to get you to the point where you've actually built an initial product. Or it might be $10 million, but this is we want to see you develop a product, okay? Now, that's your initial seed capital. So now you got the product built. Hey, that's great. About 25% of the firms actually get the product built. The other 75% are written off. Now, the 25% that get the product built, they say, now here's $20 million. Now, we want you to actually go out and get a few customers. Prove that you can get customers. Okay, about 75% of those firms fail to get customers. They write them off. And so now they've got this last piece. They have customers, they have a product. Now they start funding the growth. And a very high percentage of those will either be acquired or go public. And when they do, they make so much money off the return that it makes up for all the others. They earn typically about 40 to 50% annual. So they're very careful by diversifying their portfolio and using tranches to take themselves through this process.
So Mike, that's a point. I was just going to say, I sometimes make in my blog a point that if you had 10 markets that looked sort of bubble-like early on, if markets were completely efficient, it might be the case that 9 of those 10 would look like bubbles ex post, right? So people were calling Bitcoin a bubble when it was $30, right? So imagine there's like 100 investments like Bitcoin, 99 of them collapse, but Bitcoin goes up to 20,000 from 30. That's still a good diversified investment portfolio. That's an efficient market, right?
Yeah,
But it's going to look to the average person like bubbles are all around us, because in numerical terms, most of those speculative things won't have done well. But the ones that do extremely well will make enough profit to justify taking a gamble on a half dozen others that don't do well. So it's going to look like irrationality.
Yeah, this is why my friend, I don't know if you know who Stuart Alsop is. Stuart Alsop.
I remember that name, yeah. Reporter, wasn't he?
He's a venture capitalist now, but he was a former editor for InfoWorld and a bunch of other magazines.
Yeah.
And Stuart once said, no rational entrepreneur ever invests in his own company. Right? For this reason. Well, because it's so speculative, why would you put your money into one firm? Right? Even if it's your own firm, you don't put any of your own money. And this is why people say entrepreneurs are risk takers. It's like, what? Look, I was a 4-time entrepreneur. I never invested any of my money in my companies. Are you kidding me? I wouldn't do that. That's what venture capitalists are for. My job is to create the business and get paid a nice salary and then ultimately some stock options to get rich off of if I'm successful. And so in my experience has been entrepreneurs are not risk takers at all, good ones. They tend to get other people who are risk takers to take the risk, and then they build the business.
Would there be an exception if the entrepreneur was so good at what he was doing that he had a sort of inside information that his product was going to work better than the market itself? Might there be a few entrepreneurs who just know the technology of what they're doing and have such confidence that they're better able to price the company than the market? I think Elon Musk or someone like that. Would that be
Elon Musk? He got his money from the government. Okay. Elon Musk got his money from the government. Seriously, go look at it. He got fully funded from the government in every one of his ventures. Do I believe there are some people out there who self-funded and made a lot of money? Yes. But those people are going to be 1 in a million. Okay. And the vast majority of entrepreneurs borrowed money from relatives. My first venture, which I did not use venture capital for, and which I ended up selling to McGraw-Hill, was the original accounting software on the PC. I wrote the first accounting software for the PC. And I sold it to McGraw-Hill and made a lot of money. Now, what did I do? I borrowed money from my father and an uncle and some friends who had a lot of money. I was a college student. And so I invested my time, because I had a lot of time, college student, right? And their money. And I took a salary. So it was low risk for me because I had a lot of time sitting around anyway. And I used their money. And they made a few $1 million each, and they were happy, and I made a bunch of money as well. But after that, I just used venture capital because, hey, that's what they do. That's their job. Right?
Does the venture capital industry track index funds or the S&P? Like, where does it all shake out? Where does all of this shake out in the wash when you get to?
Where do venture firms get their money?
No. Like growth, like ROI.
No. Historically, they've returned 40 to 50% annual returns
across taking across the entire sector.
Yeah, it's amazing. But you can't get into one. Try. They won't take any of your money. If you don't have at least 10 to 20, maybe $100 million, they don't want to talk to you. Because they don't want a bunch of shareholders. They want a handful of shareholders that they're going to deal with. So they get money from Harvard and from wealthy family funds and that kind of stuff.
Yeah.
The individuals are not allowed to invest.
I have a bunch of VC friends, and it's interesting.
But see, now you're sounding like Thomas Piketty. The rich people have an easier time making more money, right?
Don't they?
Well, maybe that's true.
I'm
just throwing that out there to be annoying.
Yeah, I'm sure it is. So what?
But that's you've looked at the aggregate. Where's the goods? I mean, I imagine it's somewhat hard if the firms are private to know for sure what their ROI is. Like, is there good data on the sector as a whole?
Yeah, there is. There is a association, and it starts with an N. New Venture. Anyway, there's an association of venture firms that publishes all kinds of data on them. but you're not going to get it on individual firms. They just gather the data and aggregate.
Yeah.
They won't give out to interest. But I happen to know quite a few, about 30 different venture firms that have invested in my firm, firms over the years. So I know a lot about how their funds have done and so forth. And if you get a firm like Sequester Capital, who's like the best, right, historically.
Is that Bill Gurley? I'm trying to remember.
Sequoia invested in Google, they invested in Apple, they did, all Yahoo, all those companies. And they've just had phenomenal returns every single year all along. You get some of the newer firms like, say, Hummer Windblad or something like that, and they've had some bad years because they just don't have the experience of the deep pockets. But even them, they'll have one bad year, but the rest of the years will make up for it.
David, what's the constraint? You've said you have to be rich. Okay, I understand that, but there's also a lot of rich people on Wall Street and institutions, investment banks, extremely wealthy people who often don't make those kind of returns in their investments. So is what's keeping everybody who has that much money to invest from earning 40% the fact that there's only a limited number of opportunities available, or they need expertise and contacts in Silicon Valley they don't have? Or what's the gatekeeper mechanism that stops every rich person from getting 40% returns?
So Sequester Capital will limit a fund to, say, $1 billion. And because they just don't want to have, it's too much money to manage otherwise. So your top 20 funds, maybe 20 to $50 billion, that's it. That's just a small amount of money.
Yeah, for Wall Street, yeah.
No, they're not going to mess with it. So they limit it to wealthy individuals and to some of the funds for the university funds and things like that. Yeah. Okay. That they'll let in.
It is. I mean, Scott, when you hear the sector as a whole earns 40% returns, doesn't it get your EMH head getting a little?
Well, that's what I'm wondering. There has to be in equilibrium, there has to always be something that prevents people from just being able to do that routinely. Even the subset of people that have $50 million to invest, because even that subset is pretty large on Wall Street, right? So I don't know if it's connections, if it's
connections,
skill, expertise, but it can't be. It's not like going in and buying treasury bonds, where anyone can do it, right?
It's in the market.
You can't buy them.
Yeah.
You cannot get into them, period.
So it can't be sort of arbitraged away easily, that kind of return.
Now, if you are one of their CEOs and you make enough money, in other words, if you take one public, they'll let you in. They'll let you in. And then they want you in because they want you to be one of their mentors. They keep those people around for their CEOs, for the young firms, so that they can get advice from some of these older people, and they'll let them invest. My son right now is the head of IT for a company called Mind, M-Y-N-D. And Mind is one of these companies that's probably going to go public in a few years. And my son's going to make enough. This is his second company, make enough to retire and go get his PhD in economics. And which is what he wants. He wants to do what his dad did, get a PhD late in life. But the CEO and the top executives are all billionaires. And they've had already one successful firm and sold it and took it public and made a whole bunch of money. And then they went out and started another one. Guess what? They used venture capital though. They didn't use their own money.
Interesting.
Because they're not stupid, right? They know that there's always a risk.
Well, it's also a good first market test to see if anybody else trusts your idea enough to come in on it.
Yeah, my son was an IT director at a company called Upwork. You might have seen their IPO about a couple of years ago. They're the largest international provider of skilled labor. So you can go on Upwork and you can find anybody in the world to provide you some very specialized skill. And that was founded by my best friend, Odysseus Satalos, who co-founded two companies with me. And that was his first venture on his own as a CEO, starting that company. He recently bought a big home on Lake Tahoe. He's retired there with his family through the COVID crisis. And it's a nice place to be, and a nice big home right on the lake. But
Here, the demand in Lake Tahoe has gone through the roof in COVID.
yeah,
I hope he got on the Nevada side so he doesn't have to pay California state income tax.
Oh, I'm sure he did. But anyway, but the thing is that when my son was at Upwork, he was an IT director, and he still, when it went public, he still made a very large amount of money, but not enough to retire on. So at this company, he's higher up. He's got a lot more stock, and this is what the people do in Silicon Valley, right? You work your way through a number of these companies, and you get some hits, and then you can afford to buy a house in Silicon Valley. So we lived in Los Gatos. I raised my family in Los Gatos. I don't know if you've heard of Los Gatos, but my neighbors were, Steve Wozniak. I'd come home and his son would be on my couch asleep because he'd come home from school because he was friends with my daughter. And I'd go to the grocery store and there'd be Peggy Fleming, who she had a winery there and or a vineyard and so forth. And it was a very nice community, very, very expensive place to live. But, and we enjoyed it. It was the oldest town in California. We had an old Victorian home right near the downtown. And that home is $4.5 million now for an old Victorian home. And it's insane. I do miss it. I don't miss the cost, and I don't miss the crazy government that they have there. But it was a great place to raise my kids and get them educated. My kids' high school teachers all had PhDs from Ivy League schools because their parents had left them the home, which they couldn't afford to sell. So they, would move back home when mom and dad died. And so what else am I going to do with my PhD? I'll teach high school, right? So anyway, it was quite a place to, if you've never been there, if you go to Silicon Valley, you need to go to Los Gatos and have lunch at one of the great little bistros there and go through the shops. It's like going to Disneyland or someplace. It's a pretty amazing place. Different lifestyle now here as a professor at Ball State in the Midwest.
I did the opposite. I grew up in the Midwest, always wanting to live in California. Finally moved out here 3 years ago.
So where are you living?
Mission Viejo in Orange County.
Oh, that's beautiful there. It's nice.
Yeah, we like it. We have a view of the lake, Mission Viejo Lake, so it's nice.
Yeah. Well, I was 20 minutes from the ocean, Santa Cruz Beach, for my son liked to surf there. Of course, he had to wear a wetsuit because it was too cold. But we had 10 minutes away from the state forest, the redwood forests. In fact, I had two redwoods in my backyard. Both of them were only about 500 years old, so they were only about 10 feet in diameter.
Wow.
They were little trees. But it's a beautiful place. I'll tell you, you're lucky to be living there. The only place that would hire a man of my age with a PhD was, unfortunately, was Ball State University. And thank goodness. No offense to Jim, but I'm grateful to be here because I've got Steve and I've got Jim, and they're great colleagues, and they support me and put up with me. So.
Well, Jim.
Well, except for when you were playing with that triangle and you kept.
That's right.
that was driving me crazy.
I have all kinds of crazy ideas I brought with me from Silicon Valley.
But that one I think was correct, for sure, and I think that's a big one. And I'm glad John invited us here to talk about Sequester Capital.
Yeah, thank you, John.
Well,
thank you.
Thanks for showing up, Scott. Appreciate it.
Yeah, thank you for inviting me.
Thanks for listening to the Emergent Order podcast. If you haven't already, be sure to subscribe on iTunes, Spotify, or your favorite podcasting app. If you're interested in being a guest, shoot us an email at podcast@emergentorder.com. Our producer is Jesse Bennett. Thanks again, and speak to you next time.